Unity stock down over 30% today, a bloodbath following their first quarter 2022 results. Over the last 6 months, the stock is down more than 80%. This is just absolutely brutal. And I think in fairness, I called it. I've done several videos on Unity, effectively saying, yeah, this is a great company. It has all this potential, but the valuation is also something you need to consider. And that's why with every video, I try to have some sort of framework considering what's the value proposition for this business, what do the fundamentals look like, but also are you paying a reasonable price for it? Is it too expensive? Is it cheap? And what's a reasonable range, taking a guesstimate, what's a range of what this company could do over, let's say, a 5-year framework? And in prior videos, I said, yeah, a lot of potential, but assuming a lot of great things, I'm still only penciling out like 100% upside. And so any slight miss can result in huge downside risk. And arguably, that's what you're seeing here. So let's dive into understanding, why is the stock down today? What do I think about Unity and its future? Is this sort of the end for Unity in terms of being able to recover? No, I still think it has tremendous potential. I even think Unity can outperform the major US indices. It has that potential in the years ahead. It has the potential to outperform the major indices, US indices, let's say over the next 5 to 10 years, given their long-term growth prospects. And we'll talk about those growth prospects in a second. We'll also talk about the current valuation now that the stock has gotten absolutely bludgeoned, down another 30% plus today. If this is your first time tuning in, my name is Daniel, and you're watching Unrivaled Investing, a no-hype, mission-focused channel trying to find you exceptional companies and unrivaled investing. And this is a perfect example of why it's important to leave the hype at the door when you're looking at companies. And so looking at Unity, what do we expect here? Look, this is a special company. They are ushering in a new age where we won't even know the difference between real and virtually created interfaces. This will be an era of real-time 3D creation. So you're building 3D environments, things that are ultra lifelike in real time. They'll be able to create this super easily. I highly recommend you check out Unity Enemies, which is a trailer for one of their latest products. So why is the stock going down? Well, they reported actually solid first quarter results. They reported 36% revenue growth in the first quarter. And, you see management talking about how we believe we're in the early stages of one of the largest transformations in tech, the move to real-time 3D. And this is just a huge, this has just dramatic potential. As you effectively lower the cost, lower the frictions with the ease in which you can create 3D environments where you go, wow, this looks just like this is real. I can't tell the difference. As that becomes ubiquitous, that can affect so many different industries. And we'll talk about a couple of those industries affected. Obviously, movies is a big one. Games is a big one. But they also talk about, yeah, we're winning more customers. We closed 34 deals above $100,000, up 126% year over year. But the Unity, you're thinking about like their software, not necessarily their gaming revenue, but their software used to help model and build out these ultra realistic environments. It's being used in industries outside of gaming like construction, commerce, manufacturing, advanced simulation, and much, much more. For example, they talk about how Zutari, a South African engineering consultancy, is using Unity's real-time 3D development platform to automate large-scale solar panel projects. And this is helping them design them and also decrease the cost for, hey, how are we going to lay this out? And so as you look at this, not only are they winning, let's say, new customers, and they now have over 1,000 customers paying over $100,000 per year, but they also are seeing their existing base of customers spend a lot more. And they talked about on the call saying, yeah, we had Lockheed Martin, one of the major defense prime contractors, for the US government and Western governments around the world, say, hey, this is great software for us building out 3D projects or 3D models of things or even training. And so Lockheed Martin started off with a couple of licenses, and now it's, a couple hundred seats that are effectively paying a subscription to Unity. And so this is an example of you get one customer and that customer expands, and then they expand some more and you get more and more seats. And they talked about not only landing new customers, but their existing cohort of customers spending more. And they talk about this net expansion rate. Let me show you the exact phrasing. This strong net expansion rate of 135%. What that means is that if they didn't get any new customers during the period, just looking at their prior cohort, what you're looking at is effectively 35% growth from that prior cohort without landing any new customers. So that is a really good data point to think about. So you're landing new customers and your existing customers are spending more. Very healthy metric. So then the question is, well, I've just talked about a lot of these great things. Why is the stock getting absolutely beaten up, down 30%? Part of it comes down to just revising their guidance, saying, yeah, our guidance is going to be a lot worse than what we previously expected. They lowered their guidance for the year, certainly lowering it for the second quarter. Now they're only expecting 6 to 8% growth for the second quarter. That is a huge deceleration from what you're seeing in the first quarter. Why is that so bad? So management calls out really two main things that drove it. First is they called out, the first was a fault in our platform that resulted in reduced accuracy of our audience pinpointer tool. So pinpointer, this is effectively a tool that's sold to games. So if you own a game and you'd like to, identify new players that will pay for your game or will be monetized in your game through advertising, audience pinpointer is a tool used with those games. And so they're saying, yeah, this wasn't as accurate, the data that we had for this that effectively helps these games, monetize, it wasn't as accurate. And they further said the second is that we lost the value of a portion of our data, training data, due in part to us ingesting bad data from a large customer. We estimate the impact to our business of approximately 110 million in 2022 with no carryover impact. So what this means with both point number one and point number two is that they sort of dropped the ball. This is not an industry problem. This isn't a macro problem. This is execution problem. This is in almost every video I talk about, hey, here's a range of scenarios, but it all depends on management execution, delivering on it. This is a perfect example of whiffing. This is a perfect example of management not delivering, where ultimately this is a $110 million cost because a problem wasn't caught early enough, saying, hey, the training data we're using for helping other games monetize, yeah, it's not working. This data, we used data from one large customer and then try to apply it to all these other smaller games. Yeah, it didn't actually work out so well. So those smaller games aren't monetizing as well. And because our business has effectively two separate models, one is subscription. So let's create those 3D models. The other is operate. So where you're effectively monetizing with the gamer, saying, hey, we're going to help you monetize. We're going to help you sell ad revenue, create ad revenue for your games. We're going to help you get new users, more paying users. We're going to help you with that, but we want a revenue share. And so there's effectively this revenue share business that's directly getting hit by about 110 million. That's a real hit based on their own execution. So that's a big deal. And this is, I would argue, an even bigger deal because about 60% of their revenue comes from this operate solutions aspect. So not only is this a hit based on their own execution, but if you were to see any sort of slowdown in the ad market, this would be a double whammy. They're not seeing that yet, but it could be a real risk. And this is ultimately saying, yeah, this part of our business, that's around 60% of our revenue, the majority of our business tied to this revenue share and consumption-based models, yeah, we spotted a problem here. What are the odds that another problem, develops here? And this is also creating some little bit of maybe PTSD, flashback concerns, because here it is, the CEO, this isn't the first time this happened. So he previously resigned his post from Electronic Arts as the CEO. He wrote a letter back in 2013, and he talks about, my decision to leave EA is really about my accountability for the shortcomings in our financial results this year. It currently looks like we will come in at the low end or slightly below the financial guidance we issued to the street, and we have fallen short of the internal operating plan we set 1 year ago. For that, I'm 100% accountable. Once again saying, look, internal problems, internal operating execution effectively missing. And it's the exact same problem. Like, it's sort of mind-blowing to me. Like, you whiffed last time setting guidance. You effectively were coerced to resign from EA because you put out guidance to Wall Street and then you missed. That smells very similar to what you're seeing here with Unity. Put out guidance, come in below, and all this time you're getting a lot of stock. And it's just like, this is going, Unity should be in the penalty box because of this. And this is getting some investors saying, whoa, this is a concern. Can you trust management to execute when this isn't their first time sort of misstepping? And that will, arguably should be a discount for the stock and something that a lot of investors, might want to consider, as they look at this. And so the question is, what's the right value for Unity? Important to consider the fundamentals. Where does this business, go from here? And first, a quick plug where if you're either struggling with this current investment environment, where you're just trying to protect your savings, your investments, or you want to find potential multi-baggers, the types of stocks that can go up potentially hundreds or even thousands of percent over time, check out unrivaledinvesting.com. It's the Unrivaled Investing subscribers that keep this channel alive. So big thank you to all the Unrivaled Investing subscribers out there. And hopefully it's a big win-win for the Unrivaled Investing subscribers where, hey, you're signing up for this and hopefully you're getting ideas. You get to see my own personal portfolio, but you also can get real-time actionable ideas. And all it takes is just one that can change someone's personal financial life. If you find one of those types of things that can go up hundreds or even thousands of percent over time. And that's my own personal goal, is to try to find those things. So check out unrivaledinvesting.com. And so as we look at Unity is, yes, they're posting nice growth, but they're still hugely unprofitable, that, management will talk about, oh, margins are improving. I'm looking at this and saying, no, you still have huge losses here. You might, if you adjusted for stock-based compensation, you might say it's better, but this is still quite ugly if I think a rational person looks at it. And then you look at their dilution and you go, wow, you're still issuing a ton of stock. So guiding to revenue deceleration because of internal execution problems, huge losses, based on GAAP accounting, effectively because they're issuing a ton of stock. So this is not a pretty picture, especially in an environment where a lot of investors are like, yeah, we're potentially facing a recession. You're in greater risk off period. I want a company that's not going to dilute the heck out of me and is going to have tons of free cash flow. That is not what you're seeing here. And I want a profitable company. So you have this sort of perfect storm where Wall Street's like, why would I want to own this stock? So of course it's going to sell off 30%. It was at a very rich, I'd argue even potentially crazy valuation previously. And that's why I called out previously, like, you know what, maybe it works out, but you have to have a lot of assumptions just to get like 100% upside. And so now, based on factoring all these different things, what's the right valuation? What's the possibility for this business? And so one is, I'm looking out this year, I'm saying 20 to 30% growth. Management's guiding to slightly lower than that. So maybe it's more appropriate to focus on the low base here. I am lowering my optimized margins because, honestly, management talking about improving margins when the fact is that there's still huge losses. I think that is important to consider. And so I am doing this sort of reduced optimized margin long term to think about it. And then what's the growth rate that you're going to be able to get from here? Management talks about 30%, but once again, is that 30% after dilution or before dilution? And so if you're talking about before dilution, once again, you might be looking closer to a low or, sort of base scenario. And keep in mind, this is a hypothetical framework. Of course, stock prices can go way higher, way lower, depends on management execution and sentiment. And arguably, we're in a period where sentiment's not great and management execution isn't either. And that's not great for the stock. So looking at this, framework, I'm still not penciling out crazy risk reward. I'm still not penciling out saying, yeah, this is the type of thing that can go up hundreds of percent from here. It's still at effectively 8 times forward sales. So this is no, cheap darling or something like that. This moved from very expensive to more reasonable. Now, could it work out from here? Yes, it absolutely could. And that's why I have this high scenario saying, hey, this is a company, if they, they're tapping into all these huge fields, 3D real-time rendering is going to be revolutionary in my opinion. So I do think they have this long runway of growth. So let's say they're able to do this 30% long term and assume they're able to get nearly 30% profit margins, operating profit margins before a 20% tax rate. So assuming that, and then assuming 5 years from now you get a 30 times earnings multiple, then you could get nearly 150% upside. So that is sort of what investors are playing for, but it requires, once again, a lot of assumptions to sort of get investors comfortable. And I would want to see more sort of execution personally before pulling the trigger, or at least a better price. There are some aspects to this that I'll talk about with the Unrivaled Investing subscribers in a weekly letter that I put out that might make me consider pulling the trigger sooner. But ultimately, I do want to see better pricing personally for myself on my own personal investment journey, where I want to see hundreds of percent upside when I'm considering it. So if you enjoyed this video, please make a point of hitting that thumbs up and hit that subscribe button. Thanks so much for tuning in.